leverage at the beginning of the move after those bottoms in gold was far more in previous moves than it has been this time. So because of that, and because the US North American investor is only just beginning to turn his interest to gold stocks, right? The GDX still has over $3 billion of outflows this year. Its outflows, net outflows for the last 6 months. It's only been really in September, October, and November that you've begun to have inflows, and the inflows are much more modest than the previous outflows. I would say that we're still close to the beginning of the gold equity cycle, to be honest.
Gold is entering a phase that very few investors truly understand. A phase defined not by momentum traders or speculative froth, but by structural, global demand that continues to accelerate even as the price surges to historic levels. What we're seeing now is a market that has already digested record central bank buying, resilient physical demand from Asia, and a macroeconomic backdrop that is tightening the vise around the dollar. And yet, despite all of this, the one major group historically responsible for explosive upside, American generalist investors, is only just beginning to wake up. When a bull market begins without Wall Street, it never ends quietly. For months, analysts warned that the move in gold was too much, too fast. But every pullback has been met with hungry bids that barely allow the market to breathe. Spot gold dips for hours, not weeks, and rebounds with force. That is not speculative enthusiasm. That is the footprint of structural, pent-up demand from wealthy families, sovereign buyers, institutional allocators, and now, new entrants like Tether stepping into the market with balance sheets large enough to move continents. When pullbacks become shallow, you're no longer watching a trend. You're watching a global repricing. The global backdrop reinforces this shift. Fiscal deficits remain uncontained. The Federal Reserve is pinned between weakening economic data, a softening jobs market, stubborn inflation, and a bond market that refuses to stabilize. Meanwhile, countries across Asia and the Middle East aren't waiting for clarity. They're accumulating gold as a long-term insurance hedge. These are not tactical trades. These are generational reallocations, and they are occurring while the Western investor is still asleep at the wheel. Gold is no longer trading on fear. It's trading on inevitability. The recognition that the financial architecture built over the last 50 years is weakening, and that the safest place to be is where capital cannot be printed, diluted, or weaponized. This is why today's move matters. This is why the cycle is just beginning. And this is why the next phase could be one of the most powerful gold equity rallies in decades. In today's video, Adrian explains exactly why the gold equity cycle is still in its early innings, why shallow corrections signal a much larger move ahead, and why new entrants like Tether may dramatically alter the landscape of physical demand. And later in this video, we'll go deeper into his warnings about the Federal Reserve, the dollar, and how US investors are dramatically underexposed at a critical moment. Before we get into the first clip, make sure you subscribe, like this video, and turn on notifications. We have more deep dive analysis coming, and you won't want to miss what's next. We appreciate the support and hope you enjoy the video.
We all know what's really been driving gold over the last 3 years. It's been central bank buying. At the beginning of the year, we saw, on top of that, we saw Chinese non-official buying, and that sort of went to a huge spike. That accelerated throughout the year and went to a spike in October. And of course, we've had increased buying from wealthy families, wealthy institutions, whether in Asia, Middle East, particularly those two, but also in Europe, and to some extent in the US, just as a defensive insurance measure in the face of unrelenting and growing fiscal deficits, not just in the US, but around the world. And it's really only been North American retail, if you like, or North American generalist investors, not necessarily retail, but North American generalist investors have only just begun to dip their toes into the water. But I mean, that's obviously, we know that's what's been driving gold. What's A bit surprising to me, to be honest, is, we had the spike in October where, everybody was saying, we were saying gold's just moving too far, too fast. And we had the pullback. But the pullback has been extremely shallow, and there was no follow through at all after it got to, as you say, it dipped under 4,000, but there was no follow through. And I think that what that tells us is that there's just an awful lot of pent up demand on the sidelines from people who missed it on the way up. And, this is human nature, but it happens with every market. At 3,000, you say, well, I'm not buying gold at 3,000. I'll wait for a pullback. And it goes to 32. Well, 32, my gosh, I'll wait for it to get to 3,000. And then suddenly you're at 44,000, having just dipped from 44, and you jump in, right? Because it's pulled back. I think there's just a lot of demand on the sidelines. And of course, the central banks are continuing to buy. It's less than it was a year ago, but it's still, in the context of the last 5 years, it's still very strong demand. And importantly, it's diversified demand. It's not just one central bank. It's not just China, as you know, but it's very diversified central bank demand. And that's continuing in ebbs and flows, but it's continuing. So, yeah, I mean, I feel the big question for me, Kai, is not so much how low gold is going to go. I think, and I hate to jinx it, but I think we've probably seen the low of the correction. I thought it would go lower, but at this point, I would say we've probably seen the low. The big question is just how far, how long does it take? Yeah. And I'm sorry, if I may say just one thing before you and I'm sorry to go on for so long. Yeah, because these pullbacks often last a lot longer than people think they will. But to me, the big concern in the next couple of weeks, frankly, will be the Federal Reserve. And you mentioned 85% basically probability. That's what the markets are saying, 85% probability of a rate cut. And gold has priced that, right? Gold has priced that in. 2 weeks ago, it was more like 50-50. In fact, it was even a little less than 50% for a rate cut. But at this point, with an 85% probability of a rate cut, and with gold having already discounted that, the risk, of course, is that the Fed either doesn't cut or cuts with an extremely hawkish message, and that could see gold come down. So, as you know, in this business, we're not really in the business of making predictions as to what's going to happen. It's looking at what we think is going to happen in the context of risk and reward and in the context of what's already discounted in the market. Yeah, I should have mentioned Tether, of course. No, very, very significant, because this is not just a new entrant, but a really significant entrance, as your chart shows and as you just said. A couple of things going on. We know the Tether people, and certainly the individuals that I'm acquainted with, but we know that the Tether people like hard assets. It's not just gold that they're buying, physical gold to back their gold stable coin, but it's also gold royalty companies. They've made inroads, they've made acquisitions of gold royalty companies. We can talk about that later if you want. But it's not just gold. They've also bought farmland in Latin America, in Brazil and Argentina. So, I mean, they certainly have a hard asset orientation. I suspect, and I mean, I don't know this, I suspect that given that their main business at the moment is and has been the US dollar stable coin, where they will put money into treasuries, and of course, they're keeping all of the interest. So that's a pretty good deal for them. But as interest rates are coming down, their revenue from the US dollar stable coin is going to decline. I think they're looking to diversify out of that, and gold is the obvious candidate to do that. We might just see them build up their a separate gold-backed stable coin. So you have a US dollar stable coin and a gold-backed stable coin. I don't know. We'll see how that goes. But there's no question that they want to build up their gold holdings wherever they put them.
Adrian Day has laid out one of the most important realities of this market. Gold's ascent over the last 3 years has been driven primarily by structural central bank accumulation. What's changed, and what matters for the next major leg higher, is that this demand has now expanded beyond official buyers. Chinese non-official purchases surged throughout the year. Wealthy families across Asia and the Middle East increased allocations as a defensive hedge, and even European institutions have begun to re-enter the market. But the most striking point he makes is how little participation has come from North American investors. The same group that historically delivers explosive upside through equity buying has barely dipped its toes in. That is not a sign of exhaustion, it is a sign of phase 1. Next, Adrian highlights a dynamic Western investors rarely consider. Gold is cultural capital across Asia, the Middle East, and parts of Europe, but in North America, it is still viewed almost exclusively through the lens of interest rates, inflation, and the dollar. And right now, the narrative supporting those factors is breaking. Economic data is weakening, inflation is settling higher than the narrative suggests, and rate cuts, whether they happen immediately or not, will ultimately compress the interest rate differential that has supported the dollar. Even the dollar's recent bounce has shown no real momentum, and Adrian argues convincingly that the trend from here is downward.
U.S. generalist investment is to a large extent dependent on the dollar because U.S. investors, or North Americans generally, but North Americans don't buy gold in general terms, don't buy gold for the same reason that people in Asia or people in the Middle East or people in Europe buy. We don't have, in North America, they don't have that sort of history of where gold actually saved you. The Chinese in Hong Kong have that history where gold, when they brought gold over after Mao took over, it saved them. Vietnamese have a history of gold. Germany, Italy, these countries is still in the DNA that gold is a safe haven asset. We don't really have that in North America. So in North America, people tend to buy much more on simply the economic environment. So that's a weakening economy, lower interest rates, high and rising inflation, and a lower dollar. And, the truth is that up until very recently, I think one could argue that all of those 4 factors were exactly the opposite of what they need to be to get people interested in gold. Now, with regard to the dollar, so I think the dollar is important for U.S. investors. I don't think it's very important for the main people who have been buying, and that includes Tether, the Chinese, the central banks. I don't think the dollar is that critical for them. We know that the dollar had the largest first half decline since 1974. That's pretty astonishing. And so after you get something like that, and of course the first half of the year is an arbitrary measurement, but nonetheless, it was the sharpest first half decline since 1974. After something like that, you would expect a recovery rally. And I would argue that the recovery rally we've seen, from 97 or something, 96.5 to 99.5, the recovery rally that we've seen is very, very mediocre. And so I wouldn't be at all surprised if the dollar maybe goes up a little bit more, 100, 102 on the Dixie. But a year from now, it's likely to be lower. And that's particularly since if the Federal Reserve is cutting rates, meaning the arbitrage between US rates and foreign rates, closes even more. And you've got an administration that doesn't seem particularly interested in having a strong dollar. So I think the odds are that the dollar weakens over the next, year, 18 months, albeit after a bit more of a recovery in the near term. But this recovery is very, very mediocre.
So what is really influencing the gold price? Like we talked about it, like the Fed a little bit. We talked about the U.S. dollar here.
Yeah, no, in the short term, I think it's two things. It's people who missed that rally on the way up and now are wanting to take advantage of any decline. So that could be anyone. That could be well, central banks tend to be price inelastic, but it could be, anyone that just thought they missed it. And yeah, on a fundamental basis, I think it is primarily the Fed. And if you look at when the futures on the Fed cutting in December was under 50%, that's when gold was under 4,000. And now as the odds of the Fed cutting have increased, so gold has increased. I think that's one of the main things. But there's also, from the US investor or North American point of view, again, there's a growing sense that the economy is not as strong as the narrative 3 and 6 months ago suggested. That's certainly growing. And a growing weakness in the jobs market in particular. You've got inflation that is staying stubbornly above the Fed's arbitrary 2% rate. And let's not forget that other than the COVID spike, inflation measured by the CPI, that's not really inflation, but measured by the CPI is still above where it has been for the 5 years before COVID. It's only a COVID spike that makes us think that the inflation rate is low. So you've got stubborn inflation, and yet you've got a Federal Reserve that is likely, whatever they do in December, over the next 6 months, they're likely to cut rates more as President Trump puts his people, onto the board. And so the narrative of a strong economy, a strong dollar, high interest rates and low inflation, that narrative, however true it was or wasn't, but that narrative is suddenly shifting. And that's making US people begin to look much more at gold. Well, I'm not going to say this time is different. but normally when gold bottoms, in the first 3 months, 6 months after gold bottoming, the gold stocks will give you high leverage, like 2, 3, 4, 5 times the leverage to the gold price moving up. And because gold was moving up for the last 3 years based on central bank buying, we really didn't get that leverage. And it's only really been this year and really only the last 6 months, but we've seen the gold stocks meaningfully, noticeably outperform gold, which is what they're doing now. But the leverage is still less than the historic leverages that we've seen in 2009, 2001, 1996, 1974, and of course 1971. The leverage at the beginning of the move after those bottoms in gold was far more in previous moves than it has been this time. So because of that, and because the US North American investor is only just beginning to turn his interest to gold stocks, right? The GDX still has over $3 billion of outflows this year. It's net outflows for the last 6 months. It's only been really in September, October, and November that you've begun to have inflows, and the inflows are much more modest than the previous outflows. I would say that we're still close to the beginning of the gold equity cycle, to be honest. Now, that does depend to a large extent on gold continuing to move up, which I think it will for various reasons. But I think we're still close to the beginning of the gold equity move, to be honest. And the valuations are still very, very low.
As the dollar loses altitude, we're watching two forces that rarely converge at the same moment now move in perfect alignment. Massive structural accumulation of gold from Eastern and Middle Eastern buyers, and the early tentative reallocation from US investors who are beginning to sense that the traditional playbook has stopped working. This intersection doesn't result in a gentle, orderly market. It results in repricing, sudden, sharp, and often emotionally driven. But the most important, and perhaps most overlooked, catalyst in this cycle is the entry of powerful new buyers who are not bound by the constraints of traditional investment flows. Tether's purchase of nearly $1 billion worth of physical gold is not an isolated headline. It is a signal of a deeper institutional pivot. For the first time, major digital asset players, sovereign-aligned entities, and ultra-high net worth families outside the public markets are accumulating physical gold with an urgency that mirrors central bank behavior. These buyers don't trade gold, they take it off the market. Their presence shifts the entire supply-demand balance, tightening the physical market at the very moment the paper market structure is weakening. And here is where the serious implications emerge. When you see non-traditional, extremely well-capitalized investors moving into physical metal ahead of Western retail, it usually means they see something larger forming on the horizon. Smart money doesn't wait for headlines, or for official confirmation of recession, or for the Fed to admit it has lost control of the bond market. Smart money acts when the signals are still faint, long before the average investor understands what is unfolding. This is why Adrian's warning carries weight. By the time everyday investors finally grasp what is happening, prices may already be in runaway mode. Bull cycles rarely reward hesitation, they reward preparation. And the worse the global financial picture becomes, the more freedom gold and silver have to accelerate. A disorderly bond market, persistent deficits, geopolitical fragmentation, and weakening confidence in fiat currencies are not the backdrop for gentle moves. They are the backdrop for the kind of parabolic shifts we only see every few decades. If this is the beginning of that process, then the next 12 to 18 months will not just reshape portfolios, they will redefine the entire precious metals landscape. If you found this analysis valuable, make sure you subscribe, like this video, and drop a comment telling us where you think gold is headed next. It helps the channel reach more people, and it ensures you never miss the deep dive breakdowns we have coming. Thanks for watching.